Welcome to the daily update, where I'll go over the action in the market for Tuesday, September 26th, and then we'll see how things are looking for Wednesday, September 27th. We're kind of hitting some pretty negative things right now. We could still recover from here. That could always happen. But we're starting to see some longer term things come into play. It was a bit disturbing for us to go down to that trend line that I thought might take a few days. We ended up doing it the next day, if you watched yesterday's video. And we actually closed a bit below that. Now, at the same time, I draw the line on that chart, so it may not be exact, and I'll show you what I'm talking about there. But we're just really having some trouble right now because instead of coming down and bouncing off support, we came down, sat at support, and then fell a little bit lower than that. So we're just not looking really good. We have our short-term downtrend, which has now been confirmed. We're still working on getting an intermediate-term downtrend. We're oversold in the short and intermediate term. So there's just a lot of things coming together. Plus, we have some outside influences that I'll talk about in the video. Right at the open, we had a lower open, and we opened below S1 at 43.14. We also went down to S2 at 42.90. Some of that has to do with, even though we've been gapping the last few days, the intraday range has not been really wide, and that's what the pivot points are calculated off of. As the day went on, prices chopped above and below S2, and then we dropped further below S2, never made it down to S3. I had it calculated, and we were still 10, 15 points away from that, and we closed near the low. So no, it was not a positive day. We were down 1.47%, but volume is below average. Now, when we've been going up on below average, that can be negative. When we're going down on below average volume, you could kind of take that as positive. That's on one side, because especially if we continue to go down. Typically, what we'll see if we're getting ready to hit a bottom is some kind of capitulation, and that's usually on high volume, and we're not seeing that yet. So there's two ways that you can look at this. The technicals were negative across the board. We're oversold in the short term. We're becoming more oversold in the intermediate term. We're starting to break through some pretty significant support, but we still have some support that we can hang on to, and I'll point that out. We're just going to be watching. It's outside of the S&P 500, which is what I focus on. We're mainly watching the NASDAQ 100 right now. Some comments that we can make. The S&P closed back below the August 2022 high. We closed below that on Friday, above that on Monday. Now we're back below it. These levels tend to be more like springboards, where we're moving in one direction, we hit them and turn and go the other way. We're not seeing that right now. We're chopping above and below these levels, and we also closed below 4,300. The S&P 500 200-day exponential moving average is providing support. We haven't talked about these longer-term moving averages in quite a while, other than just showing them from time to time. And the Dow is now below its 200-day simple moving average. So we have an exponential and a simple moving average that are coming into play, and I'll show you these. The micro caps are also starting to they're starting to break below 100. And we've been watching that as well. That could be more negative. Now, you think the micro caps, what do they have to do with anything? That's more indicative of what's going on in the economy. If smaller companies need to borrow a lot, what do you think even smaller companies have to do? They have to borrow a lot too. And they can often be the real backbone of a community and a large part of the economy overall. JP Morgan Chase's CEO, Jamie Dimon, he has to come out and say some things. He said he's not sure if the world is prepared for 7%. Okay, 7% what? 7% better TV? 7% better sports? No. Okay, these are interest rates. And again, he's considered to be a rock star in the stock market world. So whenever he talks, people have a tendency to listen, especially if he has something quotable. He doesn't necessarily come out and tell us anything we don't know, but since so many people, it's like listening to Warren Buffett. It's, how many of us can actually invest the way he does? We can't, because we don't have the funds available to us like he does, but yet people still listen anyway. But that's not taken as a positive thing, so that kind of spooked the markets. Then Minneapolis Fed President Kashkari, who's a Federal Open Mouth Committee member, said that he thinks another rate hike before the end of the year would be likely if the economy is stronger than expected. So now we're getting more of that scenario where we've already been going through that already, where bad news or good news is going to be bad news and bad news is going to be good news. So watching these reports, we're going to start getting a lot of them as the week plays out. And if they're stronger than expected, the market's probably going to get spooked. And now and I'll go through this, on Tuesday, we had weaker than expected economic reports and the market still went down. So figure it out. Okay, short term, our list is getting longer again now. The CMB composite, which was off the list, now it's back on the list. The VIX 9 period with the RSI plotted on there, it was on, off, now it's back on. The same with the 20 period exponential moving average study. The Stochc RSI, Williams percent R, CCI 1420, and stochastics, those had been on the list. The force index was on, off, now it's back on. Standard deviation has been on for a few days. The percent B indicator, it was on, off, now it's back on. RSI 9 is still on the list. And then the boom indicator. And the interesting thing about that is we're turning more negative in the intermediate term with the boom indicator, but we're showing an extreme negative reading with the short-term version of that chart. And I'll show you. Intermediate term, also seeing a little bit of growth in this list. The 50 period exponential moving average, the rate of change going back 5 periods, the S&P 500 McClellan oscillator, the PMO studies, we're adding more to those now. And then the 19-day exponential moving average of the advanced decline ratio based on volume, it's starting to get extreme negative. Then we're still working through this scenario that the economy is stronger than expected. That's why the Fed's coming out and saying they might still have to raise rates. They were saying, well, we'll just have to keep them higher for longer, and that might do the trick. And that was not great for the market, but not really negative either. Now they're leaning more towards, okay, we might have to raise rates if the economic reports come out stronger than expected. Keeping an eye on the Chinese economy because so many S&P 500 companies do business with China. And then oil, since it's been going up, and really the reason why it's been going up, that's causing some concerns because Saudi Arabia and Russia came out a few weeks ago now and said the cutback that they've been doing in production, they're going to keep cutting that back until the end of the year. And that's making oil go up. That's making gas prices go up. This is not necessarily a technical rise. It's more of an inflationary rise. And that's what's putting pressure on the markets. Then this scenario that I came up with for Tuesday's video that we're declining down to the long-term trend line. And then combined, I actually changed the word there, with it also being oversold. See, I thought this would take a few days to play out and let more intermediate term indicators give us more extreme negative readings. They're negative, but they're not necessarily extreme right now. And then hopefully we're coming up to the end of this weak seasonality, the latter part of September. Well, again, today is kind of positive as far as historically, or I should say Wednesday's trading session will be positive historically, and I'll show you that. But this scenario is not necessarily holding up right for at least right now. We're potentially blowing through some long-term significant support. Now, there's still other support that we can deal with. We just have to see how that's going to hold up if we test that. The dollar was up and interest rates were up, and these are putting pressure on stocks. The dollar just continues to show some strength, and interest rates going up, that's freaking out the markets, and another reason why stocks are under pressure. We still have the 30 to the 5-year that's gone back to being normal, or the other yield curves that we watch remain inverted. Sentiment, we're dropping down even more negative. Now, if we drop below, I believe it's the 25 level, now we're going to get to more of a capitulation. Now it's going to be extreme fear, and that's often when we see some kind of a bottom. But according to this, we're not there yet. So again, if we see more declines, that could work out. And then our trend, it's negative because the red line's on top, the ADX, at least with the intermediate term, and that's the main focus, and I have to cough. Sorry about that. You got to love these take one videos. It is strengthening with the ADX. It's above its moving average. It's still below 20, but the short-term trend has now confirmed at actually going above 20. So that is a negative trend. The bias should be negative. I forgot to change that. And the momentum is also negative. Bias is usually if we have an up day or a down day, where momentum is usually looking at the last 2, 3, 4, 5 days and kind of taking them together. And out of this whole video, this is probably the only real subjective part where I actually put my opinion into it. For the rest of the video, I really like to have the charts tell us what's happening. Economic reports that came out. We had the FHFA Housing Price Index. It came in up 0.8%, double the 0.4% that we saw last time. The Case-Shiller Home Price Index, it was up 0.1%. They expected it to be up 0.5%. Last time, it fell 1.2%. So that was weaker than expected. Consumer confidence. People are just not all that happy right now. They expected it to come in at 105. It came in at 103. Last time it was at 108.7. New home sales, less than expected at 675,000. They had expected 695,000, down from the 739,000 that we saw last time. So here's some charts. The FHFA Housing Price Index, where it's continuing to go up. Now, at some point, and the real estate sector is still under a lot of pressure, and interest rates are going up, and people are finding it harder to be able to get mortgages or do refinancing. But prices are still going up. And when all of those come together, that could put even more pressure on the housing market. Here's the Case-Shiller Home Price Index, also show how it's continuing to advance. Consumer confidence. We look at the blue line, which is in the middle, how it's going down. And then the purple line is how people are feeling right now. And the gold line, which is decreasing, is how do people feel about the future? What do they think is going to happen going forward? And it's pretty negative right now. Looking at new home sales, where they did decrease right here, when you look at this annual basis here, but they have been advancing overall. And then we look at the median new home prices, the 3-month average, where it's starting to turn back up after it had been declining. Then we're also keeping an eye on this. We closed at 4.59% for the 10-year yield. According to this research put out by RenMac, when we get above 4.02%, that's when the rise in interest rates has more of a negative impact on earnings for stocks, which ultimately feeds over into their prices. Here's the intraday chart, where a lot of the move that we saw initially was the gap lower. We went down below S1, down below S2, and then we chopped along S2. We were dealing with long-term, pretty important support right about here, and we didn't bounce up off of that. And there really wasn't even an attempt to bounce up off of that. So that's something kind of concerning right there. And then later in the day, we just started to drift lower, and we closed pretty much at the low for the day. Here's growth and value, where they both declined. None of them is really, or I should say, either of them is not really doing all that well right now. Closing basis, though, we still are looking a little bit better when we look at S&P growth versus value, where it was up on the day. Now, we saw that also on Tuesday. And is there some smart money coming in and buying some growth stocks? It's kind of hidden right now, but that's what this chart might be indicating. Then on a closing basis, we're seeing growth continuing to bounce back up. It's still going sideways overall, and longer term, it's still in an uptrend. But we want to see this really go up. That will give us a little bit of hope that maybe we're getting close to a bottom. Then this is a chart I meant to show it a few days ago, but I just neglected to do that. This is just a one-day look from Monday to Tuesday, the advanced decline line based on a percentage basis, and we were down pretty heavily. So that might suggest that we've gone down a little bit too far from Monday to Tuesday. I meant to show it when we had that downward move at the end of last week. And then looking at the advanced decline ratio, we're getting close to being down pretty far, pretty fast in Tuesday's session. We're also keeping an eye on the VIX, where if we continue to follow this blue line, it's going up. That means stock prices are going down, and this tops out at about the middle of October. And looking at the VIX, my goodness, it's shot up, but we're still below 20 based on the line chart and on the bar chart. And then we're also seeing a real pickup in volatility. My goodness, look at the VIX of the VIX, where it's spiking up. Could this be suggesting that we're getting close to some kind of a bottom? And then here's the RSI 9 period on the VIX showing that we've gone up pretty far, pretty fast. Sometimes that might mark a bottom in the market. I'm not saying that this is what's going to happen, but if we're going to find a bottom, it's going to happen pretty quick here. And then this fear gauge continues to go higher. And the other fear gauge is also ticking up, showing that fear is increasing. Here's the VIX, the VVIX ratio, where we're seeing this going back up. That's negative longer term. And then with the 5-period equity put call ratio, we're going back above this 0.8 level now. As long as this is going up, that's negative. If we eventually top out and start to come down, that could be when we put in some kind of a bottom. And then our longer term 253 period simple moving average, it's continuing to go up too. When it was coming down, that was quite positive for stocks. Now that it's going back up, that's negative. The Ulcer Index continues to advance, showing that fear is increasing. The advanced decline line, we're coming down to the moving average based on price. We're breaking below the moving average based on volume. This is also quite negative. Internally, we're seeing a real expansion of the new lows in the S&P 500. Our 5 period is declining and our 10 period is also declining. We're also coming down with the advanced decline ratio and another down day, and this could also give us an extreme negative reading. This is also not really good right now because this tries to measure the smart money, and we're below a declining moving average, and it declined even further in Tuesday's session. Also, another smart money indicator is the Chaikin money flow. Now, are we coming down to a point where sometimes we've hit a bottom before? Yeah, you could make that case. We don't really use this indicator like an oscillator, but we might be able to see that as it's reading right now. We're seeing a lot of broader range weakness as the cumulative NYSE is just dropping off the edge of the earth right now. And we're really dropping below the advancing trend line with the NYSE advanced decline line. This other measurement of the NYSE advanced decline line is also showing weakness, and we're dropping down below the 200-day moving average. And I haven't shown this in a while, where our advanced decline line studies, the NYSE based on common stock, the S&P, the mid caps, those are all weak. And we're seeing even more weakness with the small caps. The ratio between risk on and risk off continues to decline, and this is turning more intermediate term negative now. And here's the condition of our trend, where we're going above the moving average. So the trend is getting stronger. We're still below 20 with the intermediate term chart. The red line is going up, the green line is going down. So this is signaling a negative trend. We're now in the short term, we've crossed above 20 with the ADX. We're above the moving average. We're going up with the red line, down with the green line. So the short-term negative trend has been confirmed. Here's the trend line. And again, I draw these on here, so you might want to be a little suspect. But for right now, it looks like we closed below this pretty significant long-term trend going from the October 2022 low, measuring to the March 2023 low. And the fact that we're down here is kind of negative. But don't give up hope yet. There's some other things that we can still look at. Also, looking that we're below average with volume. You could take that as positive or as negative because we want to see some kind of capitulation here. The Stochh RSI, these are all short-term indicators. That's extreme negative, as is the Williams percent R, the CCI 14 and 20. Then we're also well below the short-term rainbow, and the longer we stay below this, the more these lines may roll over. The stochastics, we're getting extreme negative in the short term. We didn't really turn down much, but we're still extreme negative in the intermediate short term, and we are declining and starting to get extreme with the long short term. The force index is back down to its Keltner band, so that's extreme negative. Here's the rate of change going back 5 periods, where we did that late last week and then bounced back up. Now we're back down, showing that we might have gone down a little too far, too fast. Here's the boom indicator. We're starting to get extreme negative. And this indicator, I developed it years ago. It's how far away are we above or below the moving averages. When price gets too far away, this has a tendency to act like a magnet and pull price back to it. When it acts that way, we can use this like an oscillator. And the 20 period is getting pretty far away from its moving average. So this is extreme negative. but we're looking more negative in the intermediate term, and we're in danger of crossing below the midpoint with the 200-day moving average, which is long term. The go-no-go system is still deep purple. That's negative. The highest high, lowest low values. We are declining. The blue line is starting to come down. We're below the midpoint. The red line is also declining. This is negative. The TTM squeeze continues to be negative. That's a momentum oscillator. The balance of power ticked down just a little bit. It's really hard to see, but we're below the midpoint. That's negative. The CMB composite is now starting to give us an extreme negative reading. This is supposed to be a standalone trading system when it crosses above and below these red and green lines. I use it like an oscillator, and now we're starting to get extreme negative. The 20-period exponential moving average, which has already been extreme negative, it's even more so. And now the 50-period is starting to get extreme negative. The 200 continues to decline. The BPI, this is quite negative. This is measuring the internal strength or weakness of the S&P, dropping below 50 and not necessarily extreme yet. The S&P McClellan oscillator, which was on the list and off the list, now it's back on the list and is extreme negative. The summation index based on price and volume are also negative. The NYSE McClellan oscillator, a broader range, is declining below zero and not necessarily extreme. The summation index based on price for the NYSE is declining as well as volume. The Elder Impulse system for the S&P continues to be negative with red bars. The mass index has pretty much flattened out, so I'm not sure if this is really helping us now or not. It had generated a signal a while back that kind of confused us, and now that we're really starting to move, it's not doing much. The Chaikin oscillator did tick down just a little bit and not necessarily extreme negative. The money flow, very close to getting to an extreme negative reading. The vortex, this is interesting. We actually turned down with the red line, and we're still declining with the green line, but the red line's on top, so that is negative. The percent B indicator, this means that we closed outside of the lower Bollinger Band. We're starting to get extreme negative again. Ultimate oscillator, also very close to being extreme negative. On balance volume, below a declining moving average, that's negative. We're seeing real weakness with the 200-day moving average study of the S&P 500, showing that the stocks that make up the S&P, this is starting to go down with a little more velocity now, and we're declining with the 50-period. Are we coming back to this previous low, or are we going to break below that? The PMO and momentum oscillator is declining. We're also, when we break out this oscillator, we're declining based on price and volume. The PMOs that are rising is extreme negative. We're getting close to an extreme negative reading with the buy signals. We're declining with the PMOs that are above zero. We're declining with the Swenlin trading oscillator based on price and volume and could be getting close to an extreme negative reading. The NYSE bullish percent index below 50 and declining, negative. The NASDAQ 100 bullish percent index also below 50 and declining, negative. We're below the Ichimoku cloud. That support level didn't hold, at least for right now, unless we try to bounce back up. If we do, now some of this cloud may act as overhead resistance. The slope oscillator, which is our shortest term oscillator, it's now starting to get extreme negative. The MACD, you could make a case that we're getting extreme negative. Back in March when we bottomed, this is about where we were with the MACD. But for right now, until we see some confirmation of a bounce, this is continuing to be negative. So all of our oscillators, short, intermediate, and long-term, are now negative. This moving average tree, we not only are below the 100-day moving averages, we're coming down to the 200-day exponential moving average. The market doesn't pay as close of attention to this, but notice that for right now, it's providing some kind of support. Are we going to go all the way down to the simple moving average? And we're down in the -3 standard deviation, meaning that we've still gone down pretty far, pretty fast. We're negative with the parabolic SAR. We're dropping below the rainbow with our intermediate term rainbow. The ease of movement below zero and declining, even though we're rounding out slightly. This is still negative. The Erin continues to decline, and this measures the red line and the green line, and then the oscillator calculates the difference between the two. The red line being on top, meaning that sellers are in control, and we're pegged up there right now. Where the green line coming down, that means buyers are going away, and that's why we're getting a negative reading here. We could drop a little bit more, but we bottomed out here earlier, but when we really bottomed back in March, the Arun indicator actually fell down a little bit more than it is right now. The RSI based on 14 periods, really close to getting extreme, but it's not there yet where we are extreme with the 9 period. And we're dropping below this 100% retracement level, which had acted as support before, not acting as support right now. Our longer term fib chart breaking below the 61.8% retracement level. Now on this one, is the next level going to be the 50% retracement level? And then we're having to break out the long-term fib chart. These are two Fibonacci lines on top of each other. We're not there yet, but if we continue to fall, we'll be watching to see if this ends up holding up. And these numbers that I put on here, please don't take them as anything gospel. I draw these lines, and whenever I adjust this, the lines go all crazy. So just use this based on what you see, not as far as the chart, not necessarily what you see as far as the numbers. And we're starting to drop below 100 now based on the microcap index. We want to see these stocks doing well in a good, healthy environment, and that's not happening. Here's the long-term trend study where, again, depending on how you draw this line, we're either on or just a little bit below the longer-term trend. It was kind of hoped that maybe we would come down to this, test it, and then bounce back up. But for right now, that's not what's happening. And then over the weekend, David Keller from stockcharts.com suggests that maybe we're seeing a head and shoulders top. I don't update this chart. I just wanted to include what he posted on here. But if that's true, then this could be quite negative for the market. The Heiken Ashi is still looking negative. The Kegi is really looking more negative. The Renko is negative, and the 3-line break is negative. And we had a new zero drawn in with the point and figure chart. This is a chart based on price movement, not based on time. And for the first time since last spring, we are getting a double bottom breakdown, which was generated after Tuesday's session. It's picking up this negative movement. The equal weight and the S&P 500 both continued to decline. The equal weight is actually going down faster than the S&P 500 is. This is another negative thing. The Dow lost its 200-day simple moving average. That's never a good thing. The diamonds continue to be negative with red bars. Here's a sign of potential hope with the NASDAQ 100. We came down and we tested this previous low, and we closed up off of that low. Are we going to be able to bounce up from that low, or are we going to fall down below this? That's one potential positive sign and something to watch for on Wednesday. But on a momentum and trend basis, we're negative for the QQQs. Also watching this, we're coming down to the 61.8% retracement level for the NASDAQ 100. We're coming down again to this previous low. If we intraday-wise come down, hit this, and then bounce back up, will that be the catalyst for some kind of a bounce? Now, if we just fiddle around like we did on Tuesday, come down to a support level and just sit there for a while, that's not showing much conviction. And we might see further weakness, and we might even see a close below this level. Here's the NASDAQ, where it's dropping below the support. We had been kind of hopeful that maybe this previous low might provide some support. Nope, that's not what's happening now. And we're dropping below the 50% retracement level for the NASDAQ itself. The FANG index continues to show weakness below its 50-day moving average, even though it's in a longer-term uptrend. And we're also starting to see this longer-term look at the FANG index. It could be coming down to test this previous low that was set back in August. Small caps still looking quite negative, coming down to the support level. So far, this dashed line that you see here, that is holding, but we're below the 200-day moving average, and the 50 period is rolling over. We're also wondering, are we seeing a head and shoulders top here with the Russell 2000 small cap index? The RSI is extreme negative. We're below the 200-day moving averages, and the MACD is also declining. Then the small caps, based on momentum, have switched from being neutral after Monday to back to negative after Tuesday. The mid caps also coming down to what could be some support here, dropping below their 200-day moving average. And we're back from being neutral to negative again with the mid caps and the Elder Impulse system. The transports continue to underperform the Dow. We're also seeing weakness in the Dow. We're seeing weakness in the transports, and this could be somewhat positive. Tuesday was not a good day for the utilities, which often can give some support to the S&P. The dollar continues to go up. It's well into the 106 range now, which is putting pressure on stocks. The 10-year yield still continuing to go up. And when this goes up, that means prices for this ETF are going down and are in a negative trend. Here's the 30 to the 5, which is still climbing up above the 0 line, going back to being more normal. And this is a chart that I don't show very often, except maybe in the weekly video. We're coming down to the midpoint here of this trend channel, and this measures all the way back to 2009. So this could be rather significant. Now, other times we fell below it only to come back up and blah, blah, blah. But so we're not necessarily wondering if this is support. This is more of the bias on a longer term basis. And the fact that we've been above this has been more positive. If we drop below it, that would turn things more negative. And here's the S&P to utilities ratio. It's starting to come back down after spiking up. Sometimes this gives support to the S&P, but we went through a large part of September with this ratio not really doing all that much, and it didn't really give much support to the S&P. And then here's another one that I don't show all that much now. It's a 19-day exponential moving average of the advanced decline ratio. We're getting close to being extreme based on price, and we're dropping below based on volume. Sometimes this marks a bottom. And then there's another one I haven't shown in quite a while. We take the 10-year yield for the US and we subtract the German 10-year yield. And believe it or not, it gives us a line that kind of sometimes looks like the US dollar index. And the reason I brought this up is we're seeing the correlation starting to strengthen between the top line and the middle line. So this might give us some insight as to what's happening. And then this is a chart that it was a throwaway chart when I did the supplemental video. The charts that we mainly look at are log scale. This is an arithmetic scale. And if you want to get all fancy with it, you can say arithmetic scale. It's arithmetic, okay? It's school that we took math in school, all right? Now, there were some times when we were coming up, and I drew this from the low back in 2009, and then this started to act as overhead resistance many, many times, but then we broke above it after the COVID plunge. Well, now we're starting to come back down to this level. Will this end up providing support? All right, Tom Bowley's research. We're pretty much fulfilling what his research has found, that the end of September is weak. So our outlook for Wednesday, earnings coming out, the UAW strike is still continuing. I understand Biden is now involved in it. Oh, that'll help things big time. And then this government shutdown, I'm starting to hear more and more about that. And you've got a lot of people out there that are saying, let the government shut down. This might be a good thing. We've got a lot of spending going on out there that's not accounted for, and we need to bring in the reins with all of this. And then you've got other people, what about the national parks? What about all this other stuff? Well, you know, there's a national park on the moon that I've always wanted to visit, and I haven't been able to go there yet. And so if the government shutdown comes, then I'm probably not going to be able to go. It's just, we got to get back to some reality here, is what one side is saying, where the other side is saying, well, we can't let this happen. All these things will go into default, and there's a lot of scare tactics that may come about. Okay, fine. You know, dig in, find out what's important to you. And if you like the idea of the spending being held accountable, then come to that conclusion. If you don't like it and you think that the spending needs to continue, come to that conclusion and then take it to the next step and contact your representatives. All right, student loan repayments. They're looking at restarting, which could be a drain on the economy. The technicals are negative. The intermediate term trend is still developing, but the short term trend has now been confirmed. And you're going to hear me say that multiple times coming up here. We will get the weekly MBA mortgage applications index and durable goods. That can be influential sometimes. And we're keeping an eye on the geopolitical events that right now it's about inflation, interest rates, what the Fed's going to say, and then these other things that I mentioned closer to the top of the slide. Here's the updated economic calendar for the week. We will be getting the third estimate for GDP on Thursday. That may be a non-event unless it comes in hotter or weaker than expected. But the big one's going to be on Friday with the PCE prices. Here's the Stock Traders Almanac statistics for the 27th. Where we're positive for the Dow and S&P, we're neutral to negative with the NASDAQ. And here's a look graphically showing how some of these have a tendency to bounce back up. Some of them still go down. And then we still have this idea of weakness or continued weakness going into the end of September. We are on the 18th trading day of the month. Here is the 27th, where Carson has us potentially having a little bit of a bounce for a few days before we see some more weakness at the end of the month. Here's a longer term look where we're in this yellow area, which this is where we hit some kind of big turbulence before seeing a year-end rally during a pre-election year. Here's a look at the NASDAQ, where here's coming into the latter part of September, where we typically see some weakness. We also see that same thing with the S&P. That's the green line, where it is also declining. And we're only up 33 1/3% of the time for the S&P when you look at pre-election years, going back to 1950. So our scenarios, you could lean more towards the down one. Maybe you've already jumped on that down one. The technicals are negative. We do have a confirmation of the short-term trend. We're not quite there yet with the intermediate term trend. Really hard to justify going with the uptrend right now. And so until we see some kind of a bounce that has some real conviction behind it. So you could also lean more towards the sideways trend, which there's a whole library of strategies that you can take advantage of when the market is in a sideways trend. So our warning signs, the longer term trend signals, we're still below those. Seasonally, we're weak right now. The equity put call ratio, both the short one and the longer term one, they are going up. The risk on posture is showing weakness. The oscillators are negative, the whole list that we follow for the S&P, as well as we just follow one right now for the NASDAQ 100. The cumulative new highs, new lows, that's been going on for quite a while now. The 3-month yield is still above where it was back in 2007. We're waiting to see if that will roll over. And if it does roll over, that could be giving us a warning sign. The S&P is still underperforming utilities. And even though the Staples S&P 500 ratio, it's coming down after Tuesday's session, it's still been advancing. And that can put some pressure on stocks. The Russell is below its 200-day simple moving average, wondering if we've hit a head and shoulders top. The parabolic SAR is negative and the vortex is negative, and we're dealing with earnings season. The positive signs, these are way, way in the background now. We do have seasonality and setups, and I go through those in the weekly video. The daily special K chart is still positive. We're still above the downtrend channel upper line. The Russell, the small caps, and the mid caps, they're still showing recent golden crosses, even though they've been getting hammered in the shorter term. Small and mid cap growth is still positive. The financial sector getting hammered too, but still generated a recent golden cross. So our conclusion, we're negative. The short term trend is confirmed. The intermediate term trend is still developing because it's below 20. So here we are with the short term. We are oversold. Intermediate term, we're becoming more oversold. Long term, as long as we're above the 200-day simple moving average, we are still positive. Thank you. I really hope you found this helpful. We'll have to see how Wednesday plays out. I hope you have a really good day, and I will talk to you in the next video.